E-commerce platform Shopify came out with earnings a little bit early. They were supposed to come today after the market closed, but they came out this morning and shares are up between 25 and 30%. This is a huge jump and a welcome sign for shareholders that have had a pretty rough couple of years. So what happened in this quarter and what's going to be the most important thing moving forward? It actually might not be what you think. Let's take the next 10 minutes figuring all of this out. My name is Brian Stoffel. As of the time of this recording, I do own shares of Shopify, and thanks to YCharts for sponsoring today's video. More from them in just a minute. So this was Shopify's first quarter of 2023. After this massive jump today, it is a $75 billion company. We're going to cut right to the chase before we even get to the headline numbers. CEO and co-founder Toby Lukey wrote a letter to shareholders, and it seems like it was a tough letter to write. He said that after today, Shopify will be smaller by about 20%, and Flexport will buy Shopify Logistics. Now, this is a big deal. It means that the company is cutting a number of jobs. In the letter, he talked about how managers will be a number of those jobs, but they're also saying, look, logistics, it's just not going to work as part of our company. We're going to be jettisoning that. And that was a big deal. And the market seems to like what it's reading. Now, in talking about why the company does this, Lukey did a great job going for the clear vision from 30,000 feet. He says, we find it useful to talk about the difference between our main quest and side quest. The main quest is its mission, which is to make commerce better for everyone. That's why it exists. Side quests are everything else. Now, he did say that side quests split your focus. Sometimes it can be worth it, but if it doesn't work out, then it's not, and you need to cut your losses. He said, look, our main quest is to make Shopify, to make commerce simpler, easier, more democratized, more participatory, more common. Now, some people might just roll their eyes at this, but I actually think this is a huge deal because he's clearly showing that if they continue to pursue this path of owning the logistics business, even though it's something I was very excited about, I don't know what the internal economics of it are, and it seems like it's not favorable to helping make commerce better for everyone. So the company is jettisoning that. It'll take some time to think about what that means, but it's a really important move that the company has made. Now, in terms of the results, revenue was up 25% on the top line. That beat Wall Street's estimates, and it beat management's guidance for high teens growth for the quarter. Earnings per share came in at a penny, which is on a non-GAAP basis and is about the same as last year, but it was ahead of Wall Street's estimates. Now, when we look at margins, it was kind of ugly. Gross margins went down. We'll talk about why that was the case. Operating margins on a non-GAAP basis through to a loss, and net margins were down significantly on a non-GAAP basis. So overall, I mean, that's not a very pretty picture for a company that's up as much as it is, but we'll suss all that out. Now, on the other hand, free cash flow went from negative $41 million to positive $86 million. That's a big deal. Net income took a step down on a non-GAAP basis. And look, this company does not have anything to worry about in terms of its sustainability. It has about $5 billion in cash and $1 billion in debt. It's got plenty of cash to keep going. Let's look at the income statement real quick to get an idea for what's going on. Now, subscription solutions were up 11%. That's what you pay on a month-by-month basis to use this. Importantly, the cost of those subscriptions was only up 8%, which means that gross margins from subscriptions went from 77.4 to 78%. Now, this is going to be the one part of the income statement that I'm watching the closest moving forward, and here's why. We know that the basic, the Shopify, and the advanced subscription plans that merchants need to use if they want to set up an online storefront, it bumped up on January 24th, but for existing members and for people who were merchants before that date, that bump up happens on April 23rd. Now, this was actually an important detail that I missed, and at first I was very concerned because gross margins for subscriptions should expand meaningfully because the prices are going to go up meaningfully, and this is going to be a test of the company's moat, and we'll get more to that in just a minute. If we continue on with the rest of this, what we see is that operating expenses were up 24%. The big part of that was R&D up 50%. We'll have to listen into the conference call to see if some of those jobs being cut will be in this area. So maybe it won't be as much moving forward. Not really sure. But because of that huge jump in R&D, the loss from operations widened, basically doubled to negative $193 million. Now, this other income right here has to do with the company's investments in a firm. The stock goes up, the stock goes down. That has a huge effect on Shopify's income statement, which means that this net income on a GAAP basis is 100% meaningless, and that is really important to know. Now, if looking at financial statements like this is something that you're interested in, Brian Feroldi and I are going to be holding an absolutely 100% free webinar on all three financial statements tomorrow, May 5th at noon Eastern. If you want to register for that, it's completely free. Just see the show notes below. In other news, the company said that gross merchandise volume, or the value of all the things sold via Shopify, was up 15% to about $50 billion, or 18% on constant currency basis. Now, beyond that, I think it's really important to look at this. This is an old slide that the company used to have where you just take merchant solutions and you take gross merchandise volume and say, well, how much does Shopify get to keep for every dollar of things sold? It was 2.14% in the third quarter of 2022, but now it's up to 2.29%. Most of that is because people are using Shopify Pay. So keep an eye on that as well. Now, turning to guidance, management said that revenue will grow at a similar rate that we saw during this quarter, which again was 25%. Gross margins should be similar. I'm going to talk a little bit more about that in a second. And this is important. The company said that it will be free cash flow profitable for each and every quarter in 2023. We have not seen that since the pandemic, and that was by mistake. Now, you can see here why people are excited. If revenue grows around what it did this quarter, that'd be about 25%. That is well ahead of what Wall Street was expecting. There's no earnings guidance. Wall Street's expecting a loss of $0.01 per share. For the full year, this is what Wall Street's expecting, 19% growth. I wouldn't be surprised to see that revised upwards moving forward. So what should we watch moving forward? By far, the most important thing are those subscription gross margins. Shopify is raising prices. If they can keep people on, they should see growth in subscription dollars, but also widening of margins. If they do, that means that their switching costs, those high switching costs are real because it means that they're willing to pay higher prices for the subscription. That is so important. It's the first thing I'm going to look at when the company reports next. Second, gross merchandise volume. Third, keep an eye on that take rate that I showed you for merchants. Again, you just divide the merchant solutions by gross merchandise volume, and fourth, free cash flow. Overall, I think the moat direction is stable. The only reason I'm not saying it's widening is because I want to see what happens with those gross margins for a subscription business. Overall, this still gets a 12 on my checklist. It's a very good company. It's an antifragile company. But next, let's turn to valuation. And to do that, we need to look at where is this company in its growth cycle. And I would say it's somewhere between stage 3 and stage 4. And this is where we're going to pivot to Y charts. We know that we can look at gross profit and probably the forward price to earnings ratio, and that's about it. If you're interested in using Y charts, we use it almost every day. Mention Brian Feroldi's name for 20% off, and you can start a free trial by clicking the link in the show notes below. Now, first, let's look at gross profit. After the growth that was reported today, it's about $2.83 billion, but with that huge jump in the stock price, it's trading for about 26 times gross profit. That is very expensive. And on a forward PE ratio, I mean, forget it. It's 1600. That makes this almost impossible to figure out the valuation for it. And one other thing we can do is look at that price to earnings power. Now, for that, we've got a sheet that we've created to help us out. If you get this sheet and you just type in the ticker symbol, which is Shopify, SHOP, and you hit SHOP and you hit return, it loads in here, and we want to see, well, what's the revenue? I calculated it. That's $5.9 billion over the trailing 12 months. And then we see, well, what is our earnings power potential? Now that's kind of confusing. So what I did was I went back to the pandemic and I said, back when Shopify, by accident, because they couldn't spend money because everyone was locked inside, but they had tons of business because everyone was locked inside, their free cash flow margin during that time was about 18, 19%. So let's just say if Shopify, this is purely to show what it could be. It's hypothetical, it's not real. But if Shopify had, say, a 20% earnings or 20% free cash flow margin, it would still be pretty expensive, trading at about 63 times whatever that number is, or 50 times if it gets up to 26%. The bottom line is this is still a very expensive stock, and it's one that you want to make sure that you are aware that it's an expensive stock if you buy it. Want to remind people one more time that if you want to look into the financial statements and get a better feel for them, you can register for our webinar below. Overall, this was a very interesting quarter. I'm going to keep my eye on what's happening with Shopify. Jettisoning that fulfillment part was very interesting, but by and large, my eyes squarely focused on subscription gross margins. If I have not hammered that home enough in the next quarter, and that's what I'll really be watching. We'll see you in 90 days to see what that number is. Until then, Brian, out.